Welcome to SF Commercial Property Conversations with Bruce Bean, where Bay Area investments meet expert insights. Get ready to unlock the strategies of commercial real estate success.
So today we have Vessi with us, and Vessi grew up behind the Iron Curtain. I'll let her explain the entire story of getting from the Iron Curtain to Wells Fargo to being her own investor in commercial real estate and residential real estate. So Vessi, it's great to have you. I look forward to hearing your story. So let's
Absolutely.
go.
Yeah, thanks for having me on and thanks for the warm welcome, Bruce. It's a pleasure to be here. Vessi Kapoulian. I'm a immigrant who's blessed to live the American dream and former commercial lender turned real estate investor. As you noted, my journey started way back, many years, many moons ago, behind the Iron Curtain when I was growing up in Bulgaria. And it started with a bold promise that my mom made to me, which is if you learn English, we'll send you abroad. So that got me started. That was a pretty strong motivating factor. And for perspective, you at the time, traveling abroad was unheard of. So I had no idea how she was going to do that. But then the wall fell, and eventually she actually did send me abroad to the United Kingdom and Japan. So she did fulfill her promise. And between learning English, that first trip abroad, my burning desire to see the world outside of the curtain, experience it, was really intensified. So I decided to apply to universities in the US. And the only way to make that happen was to earn a full scholarship. There was no plan B. If that didn't happen, it was very clear my family could not afford to do that. So I focused on academics and focused on the resources I had around me and was blessed to earn a full scholarship. And so I came here many years ago to pursue my undergraduate degree. But like most people, stayed on the traditional path of going to school, getting good grades, joining a large corporate firm, and started climbing that corporate ladder. So I did that for many years until a few events of adversity around the Enron scandal, my own employer going through restructures, the 0809 financial crisis, all of which left either people with either decimated portfolios or jobless, is really when that light bulb went on, and I asked, well, what if this happens to me, or even worse, what if it happens in my 60s and the market tanks and I'm not ready to retire yet? What is my plan B? I don't control corporate restructures. I don't control the markets or global financial crisis, but what I can control is my own investment choices. And at that point of time, a seed that I would argue was actually planted in me way back in Bulgaria, where at the time there wasn't really a developed stock market. So when people talked about investments, they talked about real estate and not even cash flow in real estate. It was real estate as a store of value. And so I resorted to that. I decided, well, I'll buy a home or two, and that will be my my small retirement portfolio that I could lean on if, God forbid, something like that happens in my later years. And that worked out well. The first investment did really well, so did the second, and I think that's when the second light bulb went on, and I realized, wow, this can be not just a small retirement nest egg. This can be another steady income stream that I can lean on and or potentially grow into a business one day. And so I stayed on that path, buying single family homes, duplexes, and eventually decided to scale that, which is what led me to make the transition to multifamily and so or apartments. And so that's what I focus on today is finding strong operators, vetting the deals, and then sharing those investment opportunities with people within my investor community, so they have the opportunity to diversify their own portfolios and create those income streams and tax efficiencies that I personally benefited from in the past.
So it sounds like from our earlier conversation that you go out and when you're doing a multifamily investment or helping someone do that, do you help them actually get the Fannie Mae, Freddie Mac loan?
So not necessarily. Typically, I partner with seasoned operators. Now, if they do need help with introductions to commercial lenders, I
Hmm.
can help with that. Of course, because I have been on the other side of the table as a lender now, where I used to vet borrowers in deals. Right now, as an investor, I vet operators in deals. I can definitely bridge the connection. I can also help with to the extent they need feedback on the loan term sheet, loan documents, any of that part of the process, but I don't necessarily focus on that. My focus is primarily on doing the due diligence on the investment and the operator on the front end, and then staying very closely engaged with it throughout the cycle of the investment to monitor performance and provide my input and strategic guidance if or as needed to ensure we're moving on track and navigating any surprises or curveballs.
Well, there's never any surprises in real estate, but I
Everything
would,
goes
yeah,
perfectly, right?
no, that never happens.
Yeah.
So let me see if I understand this correctly. So somebody will come to you with a transaction. You're looking at apartments that are in the 100 to 150 unit range. They provide you some numbers.
Mhm.
Do you crunch them through your own number system?
So the short answer is yes. Before I even get to the numbers, Bruce, I usually like to vet the operator. So that's usually where my conversations start because you could have a beautifully underwritten deal
Uh,
and they can take it down to the run it to the ground, right? If they operate poorly and sadly we're seeing a lot of that happen in the space today with some public names and others not so public. So I start my diligence process there, then I move to the market because you can do a lot of things to the property, but you cannot lift and shift it to another location. And oftentimes, or actually, the market data creates the inputs or the assumptions for the cash flow model or the
right,
outputs,
right.
such as the
Yeah.
returns. And so the numbers is the easy part where I get to last. Typically, I ask for the underwriting model of the operator. Ideally, it's in Excel. Ideally, it's unlocked. So I can then review in detail their underwriting and we're comparing apples to apples. On occasion, they may say, hey, we're selling our model, so I can only share with you the PDF or a locked Excel version.
Oh, yeah.
In that case, I would run it through my model, but then, of course, the cautionary word for the operator is then we may be comparing apples to oranges, and as a result, I may decide on passing on the deal. So as long as you're okay with that, then I'll take a look at it that way. So ideally, review their Excel directly, and if they don't share, for me, it's non-negotiable. Pencils down, I walk away from the deal.
Yeah. And it sounds like you're doing like one transaction a year based on this sort of formula.
He has been about one a year. Ideally, I would like to do 4 deals a year, but the market has been such that it hasn't really warranted doing more. In 21, 22, there were a lot of deals, right? So deal
Right.
flow was heavy, but competition was high as well, and the numbers were not making sense from a valuation perspective.
Oh,
Now the deal flow has reduced drastically. It's starting to come back. I've seen it come back. But again, I don't like to do deals at any cost. So I find that in today's environment, especially after having been on for many operators, right? They've been looking for deals for the last 18, 24 months, some even longer and they may or may not have done a deal. So now they're getting overly excited, and a lot of times the deals that are passing my desk is like, yes, valuations are down 30% from the peak, but it still doesn't mean you should be overpaying. So so I still see a lot of enthusiasm and for that reason, again, I haven't done a ton of deals, but again, I focus on quality over quantity, and knock on wood, that has helped with performance of my overall portfolio. So I intend to keep it as such.
So you then syndicate the deal and find money for them?
So yeah, I partner with them. Usually I insert myself on the management team. So I'm one of the general partners or co-managers on the deal. Because I'd like to have ability to sit in on the asset management calls, provide strategic guidance. And there are always projects happening. So to the extent there are numbers related, it gives me the opportunity to raise my hand and help with that side of the equation. But apart from the strategic guidance and the numbers expertise, the other value that I usually bring to a team is the money, and that of my own and my investors.
Oh, that's fantastic. So the average deal size is maybe 100 to 150 units. What price range is that?
So on the low end, I would say it's probably 8 million. On the high end, probably 24, 25 million. Of course, depending on the market and the size of the property.
And and are they typically leveraged at like 60 to 65%? What's the normal number?
Yeah, usually around 60% in the current market environment. If you had asked me that question a couple of years ago, I would say 70 to 75%. 70 is my preferred high end of the high end
Yeah.
of the leverage profile. I could go to 75 if there are other cushion levers built into the deal. Anything above that makes me nervous, and we're actually seeing now why, right? Why I feel that way. If people didn't understand before, now hopefully they've learned. Yes.
Yeah, yeah. You can't get over leveraged because otherwise you end up giving it back to the bank, and
Right.
that's no fun. So,
Right.
and the banks don't want it either, right?
Right.
Yeah.
Right. No, that's not why lenders are in business. They're not in the business of foreclosing. So,
Well,
and
it sounds like you're not doing any REOs.
no, I look mostly at stabilized or stable value add apartments, which are deals that need maybe light, I call it light rehab, the interior, exterior. We're not tearing down walls, doing ground up or doing any heavy lifts.
Yeah.
Nor do I look at properties that are that have really low occupancy. So especially with where we're at in the cycle, I'm keeping the risk profile low. So really focused on stabilized properties. I definitely um, would welcome the opportunity. I haven't come across that yet, except the deal I closed at the end of last year, but welcome the opportunity to look at properties where you have great property but distressed owner, perhaps
Yeah.
one that's run out of money, or maybe their
Oh,
credit facility is coming due. They don't want to refi, because if they refi today, they have to put in a lot more equity given the lending parameters today. So those deadlines, which by the way is coming, right? There's a pretty heavy wall of maturities right now, that will push a lot of owners to act, unless, of course, the lender extends the credit facility, which has been happening for the last couple of years. So chances are a lot of those extensions that got pushed from third and fourth quarter of last year, I have a feeling will that are coming due now will probably get pushed forward another year, because typically you're not going to wait until 30 to 60 days until your credit facility matures to take action. And surprisingly, I haven't seen the velocity of deal flow increase as much as I thought it will by this time this year. So it leads me to believe a good chunk of these deals will be pushed forward another year. Um,
is
there
part of
have
it
been, yeah. Mhm.
is part of that push forward is that the hope that the interest rates will come down?
I think that's the hope. That's the hope, but it's not a great strategy, because what we have to remember too is that there is usually a lag factor between interest rates and cap rates, and really the key variable here is cap rates. That's what's pushing the valuations or keeping the valuations low. Apart from, of course, interest rates, which increases the cost of debt. So a lot of operators looking to acquire deals now, depending on the asset class market, you're probably not going to acquire anything below a 5 cap. Most likely you'll be looking at 6, and in some markets or asset subclasses, maybe even 7% cap. But a lot of sellers, if you have to keep in mind that a lot of sellers bought these assets a couple of years ago when cap rates were really, really low, 3-4%. So in their mind, right, they never expected to sell at a 6 cap, right? So there's still a lot of price discovery happening for those that have deep pockets and can wait, or for those that have strong lender relationships and can negotiate an extension. Those who don't have deep pockets or don't have extensive lender relationships will unfortunately have to sell today, not at the cap rate that they expected to. So, I mean, even if rates fall, what we have to keep in mind is that when we talk about rates going up or down, we're talking about the short-term rates, right? The Fed funds rate, but a lot of these loans, they're based on longer-term treasury rates, like the 10-year, the 7-year, the 5-year, right? Depending on what type of tenor you're locking in. And those are still in the mid 4 percentiles. And a lot of those are driven by investors' long-term expectations, and with the deficit and the debt levels that are rising. Personally, I don't see those rates coming down in particular. So my humble view is that we're in this higher for longer environment, and even if the Fed drops the short-term rates, I don't think we're very likely to see the 3-4% interest rates we were enjoying from a few years ago. Because again, you have to add the spread, right? If the treasury, let's just say even if it drops to 4%, when you add a spread of 1.5 to 2, your all-in rate is 5.5 to 6%. So if you're someone who wants to buy a property at a positive leverage, you're not going to pay more than a 5.5 to 6 cap rate to enter the deal, whether it's now, a year from now, or 2 years from now. So a lot of people are hoping, and it's not fun to be in the seller's shoes right now, but it could be a great opportunity if you're a buyer, well-capitalized buyer, looking to enter the market.
Yeah, no, that's fantastic. So it sounds like, if I'm interpreting this conversation correctly, your first line of approach is to look at the operator and make sure that that's a bona fide, realistic, great operator. Because as we all know, sellers tend to exaggerate and change and not know their numbers very well. And so it's always probably a good foundation to understand the operator first, and
Right.
then understand the market,
Right.
then look at the numbers and decide whether they're realistic or not.
Right. Exactly. Yes.
Yeah, yeah. Well, okay, this is a fascinating conversation. Just for fun, let's end with what food you like best.
All right, so I'm vegan vegetarian, so I'll stick to vegetarian choices. And because I am Bulgarian, I will mention a typical Bulgarian dish that can be snack or breakfast. It's called banica, and it's layers of phyllo doughs, egg, and cheese. So that's one of my favorite
Wow.
dishes.
Say the name one more time, Bonito?
Banica, so it's Banitza, Banica. In some,
Okay.
yeah,
Oh,
it's
oh, all right. I'm gonna look for that. That sounds fantastic. I love it.
thank
Uh,
you.
all right. And who in the world, alive or maybe not so alive, would you love to sit with some Bonita and eat with?
Oh my God, I'd love to actually reunite with my godmother and
Ah,
as well as my grandparents, even though I was blessed to know all of them because
oh
the
wow.
family unit is very close. We all lived in the same city, got to spend time with them. I lost my grandma when I was relatively young, so never really experienced adulthood years, and would love to be able to sit and exchange a conversation, or just a hug. That I would love that.
Okay, well, I want to go to Bulgaria and meet some of your relatives. So anyway, we can talk about that was someday if that was to happen.
Absolutely. Yes.
That's fantastic. Well, let's end here. I think we have another probably 2 or 3 hours worth of conversation that maybe we'll have down the road here, because obviously the market is very interesting right now, shall we say?
Yes.
And
Very, very, yes.
and
Very dynamic.
very dynamic. That's a great word. And I think we have a lot of common folks that we can refer to each other. So I look forward to that.
That's a wrap on today's journey through the SF commercial real estate scene. Ready to share your story? Visit sfcommercialconversations.com/guest. Your insights could lead the next conversation.